In this video, I'm going to compare the different business entity types that you can choose from in the United States. So let me just give you a quick overview and then I'll go through each of these in more detail. So the sole proprietorship is really the easiest if you just have one person trying to start a company. They don't want to incorporate, create an LLC. A partnership offers the most flexibility in terms of allocations. An LLC really combines the limited liability of a corporation with the ability to be taxed like a partnership or a sole proprietorship. And then you've got the C corporation is really if the company is going public, it's going to do an IPO because it's easier to add lots of new investors when you have a C corporation. And then an S corporation is really nice for reducing self-employment tax. Okay, so that's just a quick overview. Now let's go through each of these entity types in a lot more detail and compare them. So with a sole proprietorship, as I said, it's the easiest to form. And the reason is you don't need to do any paperwork. You're not creating a corporation. You're not creating an LLC. So you just basically start doing business and you have a sole proprietorship, assuming you're by yourself. If you have multiple people doing a business, you have a partnership. Now, the owner can take a tax deduction for the losses of the business. So if the company loses $80,000, the owner can deduct $80,000 on their personal tax return, on their 1040. Okay, so you get to deduct the losses. You don't get to do that with a C corporation, right? If you have a C corporation and you're a shareholder, you don't get to deduct the losses. The corporation could take the losses forward, but the owner doesn't get to deduct them. And then you just have one layer of tax. So basically every one of these business types has one layer of tax. They're what's called flow-through entities, except for C corporations. C corporations have double taxation, which we will talk about. Now, the disadvantage of a sole proprietorship is there's unlimited liability in terms of the business's debts for the owner. Okay, so if someone slips and falls outside the business and they sue the owner, and then the business doesn't have enough money to pay, that person who is suing the business could come after the owner for their personal assets. They could try and take their house or something, right? So there's unlimited liability, which is why some sole proprietors will choose to form an LLC. They'll have what's called a single member LLC where they say, okay, now I want limited liability. But we'll get to that. And again, we can only have one owner with a sole proprietorship so you can't take on other investors. Otherwise, they'll become a different type of entity. And of course, you're going to be subject to self-employment tax, which at the time of this video is 15.3%. That is beyond the income tax that you'll be subject to. You're going to be subject to you basically have Social Security and Medicare. Yeah, I'll make another video where we'll talk about that in more detail and show you the calculations. Now, a partnership is also easy to form like a sole proprietorship in that you're not incorporating, you're not creating an LLC. You just have some people, you have two or more persons agree to form a business and you have a partnership. Now, you should draft a partnership agreement though. Now, partners can deduct the losses of the partnership. So that's similar to sole proprietorship. Now, there's also one layer of tax. Even though the partnership files Form 1065 for its partnership tax return, basically the profit or loss of the partnership flows through to the partners and they are taxed. So you only have one layer of tax. Okay, now, one of the nicest things about a partnership, when I mentioned flexibility before, is it can make special allocations. I'll give you an example of special allocation. Special allocation where we say, let's say you got two partners and they each put up half the capital to start the partnership. So they each put up 50% of the capital. So you'd say, well, there are 50 partners. But the partnership agreement could say, you know what? The first partner is going to get 60% of the profits and the second partner is going to get 40% of the profits. You could reach a different agreement. Or you could say that one of the partners is going to get 100% of the depreciation allocations. 100% of the depreciation is going to go to this one partner. Now, there are rules about the special allocations, but this is the only entity type. You're basically making these different allocations. You can't do that with an S corporation. An S corporation, if you're 50-50, let's say there's two shareholders, one person owns 50%, the other one owns 50%, you have to divide up the profits and losses 50%, depreciation, all of that. Okay, so partnership has this flexibility, and then any entity can be a partner. You could have a C corporation be a partner. That is the distinction from an S corp. An S corp, there's restrictions on who can be a shareholder, who can be an owner, and we'll talk about that next. Now, another nice thing about partnerships, there's not typically a gain or loss on distributions to the partners. With C corporation, when there's a distribution to the shareholders, it could be taxed as a dividend. Okay. Now, With the partnership, similar to sole proprietorship, the owners, which in this case partners, have unlimited liability unless if they are a limited partner. Okay, I'll make a video where we talk about limited partners. The limited partners are only liable to the extent of their investment in the partnership, or you could have a thing called a limited liability partnership. Now, if you want to add an additional partner to the partnership, the downside is you need approval of all the existing partners. So that can make it hard to bring on new investors. Okay, CCorp is easy, and you can always bring on new shareholders, and there's no restrictions on that. Now, there's also self-employment tax, so guaranteed payments to partners, which I'll make a video talking about what guaranteed payments are, and then profit allocations, those are subject to self-employment tax. Now, the S corporation, shareholders can deduct losses of the business. There's just one layer of tax, even though we have a corporation, which is one of the downsides. You have to file articles of incorporation in one of the 50 states to create a legal entity, and then you have to make an election to be treated as an SCorp. Okay, so you've got that hassle, but you only have one layer of taxation. The profit of the business, so let's say the business does $100,000 in profit, and you own 25% of the shares, then you're going to get a pro rata. You're going to be taxed on $25,000 of income. Okay, so you just got one layer of tax. The profits just flow through to the shareholders. Now you have limited legal liability. Okay, if the business does something bad and people go and sue the S corporation, they can't come after like the house, the personal assets of the shareholders in the S corporation. Okay, so there's limited legal liability. That's one of the nice things about a corporation, an S corporation or a C corporation. And also similar to a C corporation, any type of corporation has unlimited life. There's a sole proprietorship, for example, the business ends when the sole proprietor dies. The business dies with it. But with a corporation, it's like a separate entity. It's a separate legal entity. Now, one of the nicest things of an S corporation is you can reduce self-employment taxes. Okay, so if the business, so let's go back to, let's say the business has $100,000 of profit. What you can do, so you can basically pay us. So you're required to pay a salary. So let's say I'm running an S corporation, and so I have to pay myself a salary. So that salary has to be reasonable. I'll make a video on this, but let's say it's $60,000. So then after the $60,000 comes out, there's really $40,000 left of this. So then there's $40,000 left of profit, so to speak, that I'm getting of income. Okay. Now that profit allocation, that $40,000, let's just say I'm the only shareholder here. So that $40,000 is not going to be subject to self-employment tax. It'll be subject to income tax, right? I can't get out of that. But only the salary will be subject to self-employment tax. Like the remaining profit, right? You can think about that as a dividend, but it doesn't have to be distributed in any event. I'll make another video about that. But basically, it's a real reason a lot of small businesses decide to form an S corp is to reduce their self-employment taxes. Now, again, I said you got to file articles of incorporation. You got a lengthier tax return. It's a Form 1120S. You can't make the special allocations that a partnership can, and there's a lot of restrictions on number of shareholders. You can't have more than 100. And then who can be a shareholder? A C corp cannot be a shareholder in an S corporation. A partnership cannot be a shareholder. A non-resident alien cannot be a shareholder of an S corporation. And it has to be a domestic corporation. So that means it has to be incorporated in the United States, and it can only have one class of stock. So you can't be like, oh, well, we have common stock, we have preferred stock, and so forth. Because there's a lot of restrictions on S corporations. C corporations have limited legal liability and unlimited life like an S corporation. However, it is easy to add shareholders. Anybody can be a shareholder in a C corporation. Okay, so you can have any number of shareholders. You're not limited to 100 like an S corp, and you're not limited to who can be a shareholder. A non-resident alien can be a shareholder. Anybody can be a shareholder. You have any number of classes of stock you want. So basically it's a lot more, it's easier to onboard new investors. That's why I said, like, if a company is going public, almost always it is a C corporation, because when you're going public, you're trying to raise money, by bringing in new shareholders, and you don't want all kind of restrictions and so forth, or say you can only have 100 people. So going public, you generally want to be a C corporation. You still have to file the articles of incorporation, whether it's a C corp or an S corp. One downside though is the losses of the corporation, as I mentioned earlier, they're not deductible to the shareholders. So if I'm a shareholder and the business lost $200,000 and I own 10% of the company, I can't be like, oh, well, I'm going to get 10%. of this loss, so they have a $200,000 loss, I can't say, well, I got a $20,000 deduction on my personal tax return. Does not work like that. Now, the business can carry the loss forward and offset future income. That's different. I'm talking about the shareholders cannot deduct the losses of a C corporation. And the C corporation is subject to double taxation. So this is the only entity type here that I'm talking about that's subject to double taxation. So the C corporation, they are taxed on their profits, right? But then if they then pay out some of the profits to the investors, to the shareholders can be taxed on a dividend. Okay, so this is taxed twice. Whereas the other entities that we talk about, like SCorp, the profits of the business just flow through to the owners and are taxed at the owner level. Now, an LLC is kind of a combination. I mentioned earlier it's a combination in that, let's say you have a partnership, right? And you say, okay, you know what? I'm really worried because this partnership, has unlimited liability. I don't want to get sued for something. What you could do is say, you know what? I'm going to set up an LLC. Instead of a partnership, I'm going to have an LLC. I have to create this within one of the 50 states. Like I actually have to do so. I can't just say, hey, guess what? I got an LLC, right? It's not like a sole proprietorship. But you create this LLC, and now what you can do is you can elect to be taxed as a partnership, for example, or if you're a sole proprietor, you can basically elect to be taxed as a sole proprietorship, right? So if you're a single member LLC, you can be taxed as a sole proprietorship. If you're a multi-member LLC, you can be taxed as a partnership. Members are just what we call the owners of an LLC. So you can be taxed as a partnership and yet get the limited legal liability of a corporation. So it's kind of like seen as like the best of both worlds. You get limited legal liability, but you can be taxed as a partnership, or if you're a single member LLC, be taxed as a sole proprietorship. So why doesn't everybody do that? Why do we have any partnerships, or why doesn't everybody just create an LLC? Well, it's only started in 1977, so it's a relatively new form of business entity. There's not a lot of established case law on it. So in some cases, if you have a complicated transaction, might not be clear case law about how this would be taxed. And so some people might prefer to say, you know what, let's just have a partnership or something like that and not form an LLC. But LLC is extremely popular form of business because you're getting that combination, the limited legal liability, but you can also choose how you be taxed.